Alright gang, this is chapter 3, part 3, continuing on. Still in the first part of the 4 main sections, types of adjustments and accruals in chapter 3. This is the last piece of part 1 called depreciation. And don't worry, the other 3 parts are not as complicated. This first part is, of course, the most complicated. So depreciation is also similar to a prepaid expense in that, just like supplies and just like prepaid expenses, in that when we first go out, our company goes out and spends money on an asset that we own. Yet over the passage of time, as we use it up, we're going to use up value of this asset. But depreciation is a bit unique. It generally deals with large plant assets. These are tangible assets that we're going to use over a long period of time, and specifically that we use them in our operations. But we're going to stick with the simplest kind of depreciation, and that's just straight line depreciation, right? And I think an easy way to think about depreciation is, let's assume we had a company and we went out and bought ourselves a vehicle, right? A truck, a delivery truck, which is in essence just a car. And let's say it cost us $10,000 for this car. Actually, let's go up. Let's go up to $50,000 that we purchased this delivery vehicle for. And we plan on using it for the next 10 years. Well, we all know how cars operate and the vehicle about the value of cars, right? While it may cost $50,000 today when we purchase it, 5 years from now, it's not going to be an asset that's worth $50,000, right? If we have it for 5 years, we're going to use up some of that value. And it's certainly not going to be worth $50,000 in 10 years. So depreciation is just a way of slowly recognizing that that asset, we are using up some of its value as time goes on and as we use it up. Now, the easiest way to do that is just divide it over its useful life and assume that it is going to be losing value, or we're going to be using up value evenly during every period, be it every month or be it every year. Is that actually what happens? No, but it's at least a simple way for us to do it, and a way that's comparable to other companies. If they all use the same sort of methods, things become kind of comparing apples to apples, and it becomes comparable, which is one of the main goals of accounting information. Remember, it needs to be useful, reliable, and comparable. So straight line depreciation, what we do is we take the original cost, which is fairly simple for us to determine, right? If we go out and buy it for $50,000, well, that's the cost. Then we're going to subtract the salvage value, which is a bit of a new term for everyone, but really that's all that is that if we're assuming this thing has a 10-year life, what's it going to be worth at the end of 10 years? And don't worry, you will never have to calculate that. I will always give you what the salvage value is. And as accountants in the real world, we would go up to a manager or someone in the delivery area and say, look, what do you expect this thing to be worth? We wouldn't have to come up with it. If we did, we'd have simple estimation process. We're not actuaries. We're not appraisers or anything like that. Don't worry about it. For purposes of this class, I'll always tell you what the salvage value is going to be. And that is just, what is it going to be worth at the end of its useful life to us? It might be useful to someone else, but as long as we plan on keeping it, what will it be worth at the end of our use? And of course, useful life, which is the denominator in this equation here, is simply how long do we plan on using it. And that can be in months if we need to figure out a month of depreciation, or it can be in years if we're only doing a year of depreciation, depending on what the question is asking for. So let's go ahead and take a look at an example here. On December 1, 2011, we go out and purchase equipment, right, for $26,000 cash. So real straightforward here when we go out and purchase it, right? We're obviously spending cash, so our cash needs to be reduced. To reduce an asset, we, of course, credit that asset. So we're going to be crediting cash for $26,000, and we're going to create a new equipment account for this large piece of equipment that's $26,000. That's an asset that we're getting in exchange, right? Not an expense. We're getting an asset, a piece of equipment that's going to benefit us in the future. We now own it. So we'd be debiting an equipment account. And we would, of course, be creating our own equipment account. Each large plant asset will have its own account, and I'll explain why in just a bit. Now we go and find out that this equipment has an estimated useful life of 4 years or 48 months. We do care about a month, right? Because we're going to be using it for 1 month in 2011. So our company's going to keep this for 4 years, we find out, and our company expects to sell the equipment at the end of its life for $8,000 cash. Now again, just take this as gospel. You do not need to sit there and say, it's not going to be worth $8,000, or what if we don't keep it for 4? Don't worry about it. Take whatever facts I give you and assume they are just that, facts and absolute truth. So we found out the other things, right? We've got the cost, $26,000. We've got the salvage value of $8,000. That's what we expect to salvage it for, sell it at the end of its useful life. And we know the useful life is 4 years, right? So remember what we've been doing here. We've got a piece of equipment that's $26,000. You can start to anticipate. We're buying it on December 1st. We're going to put out our financial statements on December 31st. Are we still going to have a piece of equipment that's worth $26,000, or are we going to use up 1 month's worth of value? And that's what we're going to be calculating here, is months. So I am going to use the 48 months as the denominator. But remember, this is the formula for calculating straight line depreciation expense. Let's go ahead and input our numbers. We know the cost is $26,000, salvage value is $8,000, and the useful life is going to be 48 months. So let's go ahead and put those in, take a look at what it looks like. $26,000 cost minus the salvage value divided by 48 months. Let's first do what's up top here, right? Simple algebra. It's going to be $18,000. And this is a term too. This is called the depreciable value. Meaning this is what our company expects to use up, right? We bought it for $26,000. We're going to use up $18,000 of the value of this piece of equipment, and it'll be worth $8,000 at the end. So $18,000 is what we're going to use up, and we're going to use that up over the next 48 months, which means we're going to use up, if you divide those two, $375 a month. Again, does it happen exactly this way? No, of course not. But we're going to use very simple estimations because they are comparable, right? And reliable, useful information. Everyone can see how we did that. So we're going to use up $375 a month of this truck. As long as we own it, we're going to assume it's going down in value $375, and we're using up that $375 worth of value in our business, right? We're using this equipment, be it a delivery truck or whatever it may be. So it is an expense that is helping us earn revenues. So we want to match this expense. So we purchased this piece of equipment for $26,000 on December 1st. It's now December 31st. We've used up 1 month worth of this vehicle, right? Or this piece of equipment. So remember, each plant asset is going to have its own general ledger account, right? When we first purchased it, we would have debited the account by $26,000. But remember, that was December 1st. December 31st, we don't have a piece of equipment that's worth $26,000. We've used $375. But this is dealt with a little bit uniquely. I'm going to show you what I mean. Unlike the supplies and unlike other prepaid expenses, we will not actually credit the equipment account. Every plant asset is going to have a sister account, right? That's called accumulated depreciation, whatever this is. So if this was a delivery truck instead of equipment, let's just call this the delivery truck that's worth $26,000. Then to show that we have used up $375 of that delivery truck, we would credit accumulated depreciation dash delivery truck. Whatever that asset is, it's going to have a sister account called accumulated depreciation and whatever that asset is. So we have a hand glider. I don't know how that would be useful for a business, but let's assume it is. If we have a hand glider here, right, and I want to show that we've used up some value of the hand glider just by the passage of time or actually using it, we would have a sister account called accumulated depreciation hand glider, okay? Whatever this is, each plant asset, that's the large tangible assets that we use in our business, will have a sister account that's called accumulated depreciation. And of course, it's called depreciation expense, right, when we use it up. So when we post this new and unique adjusting entry to the ledger accounts, this is what it'll look like. Equipment is $26,000, but the accumulated depreciation equipment account, and I'm sorry I couldn't fit that in here, is credited the $375. But the way we do it is to see what the value of each piece of equipment would be is you take the asset account and you take its sister accumulated depreciation account and you subtract. 26,000 minus 375 gives us what's called a book value, right? If you were to look at our accounting books, both the asset account and its sister accumulated depreciation account, you would come up with what's called the book value, right? $25,625 as of December 31st, because we've used up a month's worth of it. Now, this is a new account that I want you guys to be aware of. Accumulated depreciation is what's known as a contra asset account, meaning, remember, it's a sister account. It's right next to it, literally comes right after. If this was account number 150, then this would be account number 151. So accumulated depreciation sister accounts are asset accounts, but they behave the exact opposite of an asset account. They have a normal credit balance in them. To show an increase in accumulated depreciation, we credit them. To show a decrease, we would debit them. So they act the exact opposite of an asset, and as such, they are called contra asset accounts. Let me show you what it looks like on our financial statements. We would list every piece of equipment, and we would subtract out its accumulated depreciation to show, hey, we've got a piece of equipment worth $25,625, or a delivery truck, and minus its accumulated depreciation. So a delivery truck with a cost basis of $25,625. That is its book value, right? It's the cost minus the accumulated depreciation specific to that asset. I hope that was explanatory. I know it took a long time for depreciation, but I really wanted to focus on it because we will see it again. Don't spend too much time. I do want you guys to understand this, but hopefully it's not all that complicated, and we won't be diving too deep into it. We'll take up again we'll stop here and we'll take up the next slide. We'll start with part 2 of chapter 3. And remember, I know that part 1 actually had 3, right? We had prepaid expenses, supplies, and depreciation. The remaining 3 are not nearly as complicated, so we will get through those quickly. Don't get jaded. This is a very important chapter. Trust me on that. Chapters 2, 3, and 4 are the most important, so stick with me. Go grab yourself a snack or a soda or a coffee or a double shot, whatever it takes to stick with me on this. It's real important that we get through these last 3 together, and you got good spirits to do it. See you on chapter 3, part 4 coming up.